The following is an audio podcast of WheelerFrost Wealth Manager's semi-annual economic outlook. The presentation was conducted on Thursday, April 18th at the offices of WheelerFrost, located at 2665 4th Avenue, San Diego, California. The presenter was Ken Frost, CFA, Executive Vice President of WheelerFrost Wealth Advisors. To receive a complimentary copy of the slides mentioned in this presentation, please contact WheelerFrost Wealth Managers at 619-491-0225 or contact us by email at followus@wheelerfrost.com.
So this is our semi-annual update and discussion about what's going on with the economy and the investment markets.
Perfectly fine, thank you.
And I'm going to try and stay out of your way because I have a tendency to stand over here, but I'll try and stand over here. Okay. So the last few times we've had these talks, I've kind of tried to give the usual update and then focus on one or two topics that I thought was of primary interest. For example, last time we talked about the fiscal cliff and the election, all of which didn't seem to matter because the stock market went up anyway quite a bit, even though we had all those issues. We've talked about inflation and why inflation hasn't been taking off yet and different inflation measures and so forth. So this time I'm going to give the usual little backdrop about what's been going on. And then we're going to talk about a little bit kind of a longer term topic, which is really where's the U.S. going in like a 10-year frame instead of like a 2-year or 1-year or 5-year frame. And there's some interesting aspects to that should hopefully be interesting, but also should affect the investment environment going forward. So as a bit of a backdrop, I'm going to kind of summarize a lot of these slides, and if I say anything that you don't understand, just ask me. And if you have any questions about it later, you can certainly call us or anything else. So just as a background on the economic environment, I've listed several countries and areas here and what the economic environment is in those various areas. So for example, in the U.S. over the last 4 quarters, real gross domestic product, which is the most common measurement of economic growth, has advanced at 1.6%. Historically, going back to World War II, the U.S. usually grows at an average of about 3%. So that's about half the average. It's been very sluggish, as we all know. And I'm going to tell you later that that's probably what you should expect, but that's kind of where we've been. You can see that the unemployment rate at 7.6% has come down from a peak of over 10. It's not anywhere near where we want it to be. It's not where the Federal Reserve wants it to be. It's not where the administration wants it to be, but it is grudgingly moving down, but again, at a very slow rate. I put this chart together prior to the recent Consumer Price Index release. So at the end of February, consumer prices were up 2% over the last 12 months. At the end of March, they were only up 1.5% over the last 12 months. The CPI for March was actually a negative number because of a decline in energy prices. The thing I want to point out, though, is if you look at a country like Japan, its growth rate is barely positive at 0.4. The euro area is really in a recession with declining GDP at 0.9%. The areas that you see any growth at all really is in the emerging markets, China at 7.9, India 4.5, and so forth. So point number one to keep in mind for later in the talk, developed markets as represented by Western Europe, Japan, the U.S. even to some degree, relatively sluggish or negative growth, faster growth in the emerging markets. Just a quick picture on the employment situation. Again, in the U.S. through February, the unemployment rate was 7.7. Again, since this slide was put together, it has gone down to 7.6. During the recession, we lost 8.8 million jobs. We've gained 6.4 million of them back. Again, a very sluggish response, but grudgingly improving employment situation. I used to show this slide quite a bit when we were in the middle of the recession, talking about these four cyclical areas in the economy which have a tendency to drive the economy. We all know that consumers are the biggest portion of the economy, but consumer spending tends to ease up a little bit, it tends to ease back a little bit. What really causes you to go into a recession or to recover are these four more cyclical areas of the economy. And the point I'm trying to make here is that three of those four areas, capital goods, inventories, and light vehicle sales, auto sales basically, have all rebounded out of the recession from very deep lows back to what you would generally call a normal level. What hasn't rebounded all the way yet is housing starts. It has been grudgingly improving. I'm sure all of us know realtors. I have some realtor friends, and they're really talking about the fact that housing is really starting to pick up. There's multiple bids on houses. There's very low inventory. So we are starting to see a need for more housing production, and we're starting to see home builders have better results as they're building more houses. Speaking of that, here's a chart on the housing situation. The keys here really in the lower right-hand panel, you can see that inventories are quite low, certainly much lower than they were at the peak of the market back in 06, 07. The other thing that's a very high importance here is the fact that interest rates have gone down so much that you can now get a 30-year mortgage we've been doing some refinancing for some of our clients. We haven't, but facilitating the refinancing for some clients. Getting 30-year mortgages at 3.6, 3.7. It now, on a national basis, on average, costs you more to rent than it does to buy because of such low mortgage rates. And then, of course, we're starting to see home prices with that increasing demand starting to turn back up again.
Can the housing market be a big jump start for the economy?
I think it can. Now, because of the big decline it took during the last recession, housing's percentage of the economy has actually shrunk quite a bit. So it's not going to be as big a boost as it might have been 20 years ago. But yeah, I think it can. The consumer is, most of what I'm going to tell you here is really the fact that the economy has been getting gradually better. Most things have been getting gradually better, not at the rate that they would have in past recoveries. The consumer situation has been getting gradually better. There's a couple of things of note here. Number one, total assets among citizens in the U.S., and this is a Federal Reserve statistic, are still below the peak reached back in 2007, but net worth has actually exceeded its peak, and primarily that's because consumers have been paying down debt. So their assets, their liabilities have gone down more than their assets have gone up. And one of the keys there is this household debt service ratio. Again, this concept of low yields has caused the amount of money that the average consumer has to shell out each month for their car loan, their home loan, whatever, has gone down so much such that the household debt service ratio is back to what it was in the 80s. It's gone down dramatically.
And is that corrected for inflation?
No.
So
It's just a nominal number, right? Corporations are in excellent shape. Really, the corporate story is one that the previous recession, the tech bubble back in 99 and 2000, once we hit that, corporations really got their act together and got their balance sheets and their finances in very good shape. So they were actually in pretty good shape even when they hit this last recession. And they're in even better shape now. On the right-hand side, you can see the debt-to-equity ratio among the S&P 500 is currently at 108%. The average is going back into the 90s is 173%. So their leverage is much lower than it used to be. Their ability to pay debt is much higher than it used to be, as you can see in this lower panel. Earnings before interest and taxes is covering their net interest payments by 7.2 times. And then the upper left-hand panel shows that they're generating a lot of cash internally, a lot more than they need for their capital expenditures. So those excess funds can be used to pay dividends, to buy back stock, whatever they want, but they have a lot of excess cash generation. The central bank policies worldwide are an area of controversy, obviously. There's any day you pick up a paper, you talk about the Fed funds rate being at 0.25% is way too low. It should be raised. Or you read Paul Krugman in the New York Times talking about how they should be doing even more. It really depends on who you read. But there's a couple of interesting points to be made here. So number one, if you look at the U.S. Federal Reserve current policies, they're holding rates very low. They're involved in what has become known as QE4, or quantitative easing, and this is the fourth iteration of it, where they're purchasing $75 billion of securities each month in order to basically force down the level of yields in the economy and keep them low. So they're purchasing treasuries, Fannie Mae and Freddie Mac debt, as well as other mortgage-backed debt in order to keep a lid on interest rates. But this time around, they've changed it a little bit. Instead of it being completely open-ended, they basically said there's a couple criteria that we're going to look at before we start to ease off on that. Number one, they want to see the unemployment rate get down to 6.5%, currently at 7.6%, so they have a ways to go. Number two, they want to see inflation expectations rise to 2.5%. Now, expectations is kind of a vague term. So it's not that they want to see the consumer price index rise to 2.5%. What they want to see is the bond market's implicit expectations rise that high. They want to see forecasters forecasting inflation to get to that level. And if they see that, then they'll back off and try and kind of cap that. Essentially, what's been happening in the U.S. and really worldwide is that if you look at the European countries, they really have official austerity programs. They have a problem in the Euro nations with their budgets being way out of whack, and they've had to have official programs of cutting back on spending. We don't really have that in the U.S., but we've had what is essentially a de facto fiscal austerity, and I'll show you a chart on that in a little bit. And so what's really happening is that the Fed is taking the place of the federal government in terms of trying to stimulate the economy, and they're doing that through their monetary policies and these unusual policies of quantitative easing. The European Central Bank has their own very light monetary policies and what they call their outright monetary transactions in order to try and boost the banks in Europe and again, stimulate the economy. Japan has just recently started on a very aggressive program where they're basically copying the U.S. by doing large purchases of securities in the open market with the specific goal of trying to boost inflation to 2%, because they've basically spent 20 years with an inflation rate of essentially zero or negative. And they want to boost that up to get people to spend more and basically feel better about things. So if you look at it on kind of a global basis, I think you've all seen this chart before. So essentially on the bottom panel, we're looking at various countries and what their official policy level is. And in the U.S., that's the Fed funds rate. So the brown bars show what the target policy rate is. The gray bar shows the inflation rate. In a normal environment, that target policy rate is going to be higher than the inflation rate. So typically in the U.S., if we're at 2% inflation, this target policy rate is going to be 2.5% or 3%. We're currently at 0.25. And that's what you see with this diamond being in the negative area. So you can look at any of these particular countries. Up in the right-hand panel, you can kind of see it summarized by emerging markets versus developed markets. And you can see that really the emerging markets are where you kind of have normal policies because they have faster growing economies and really healthier balance sheets, versus the developed markets where everybody's trying to stimulate things. And then the result of that is up on the upper left-hand panel, you can see that the assets on the books of the various central banks, because of these policies of purchasing securities in the open market have ballooned to very high levels. So the concern about that, obviously, is that that's going to be inflationary down the line. Yeah, I hear this all the time, and we've talked about it, but inflation so far has not shown itself. But there is risk that it will be there down the line. So one of the things, several of the things we monitor are right here. What does the inflation environment look like, and what are some of these factors that tend to feed inflation? So just as a top-line review, so again, the CPI for March, it was only up 1.5% over the previous year. And the core, which strips out energy and food, was up 1.9. Remember, the Fed's actual target for inflation had been 2%, and now they've said if it gets to 2.5%, then they're going to take away some of their stimulus measures.
Does that include housing?
Yes. In fact, housing is about, I think it's about a third of that. Another thing to look at is what's called pipeline inflation. So, we most commonly measure inflation by the consumer price index, which are obviously prices that we pay as consumers. But there's, various levels of inflation where, Walmart pays a certain amount to their suppliers and their suppliers pay a certain amount to theirs. So there's pipeline inflation that theoretically passes through to the consumer. So the producer price index is one of those things that you can look at. In March, its inflation rate was only 1.1% year over year. So you understand why the Fed has been concerned in the past about deflation, because the inflation rates really haven't been very high at all. Core increased 1.7. Commodity prices, which can put a strain on inflation, have really been unchanged since early 2011. The manufacturing capacity in the U.S., there's a lot of excess capacity, not only in the U.S., but really worldwide. And you combine that with a high unemployment rate, you don't have a lot of pressure from inflation there. Monetary velocity, which is really the amount of money in the system and how often a dollar turns over in the economy, is very low. And frankly, you don't see inflation unless that picks up. And you have a negative GDP output gap. And I have a chart on that to kind of explain that. But basically, there's a measure of what the potential of the economy is, and if we're actually growing above potential, it tends to be inflationary, and if we're growing below potential, it tends not to be inflationary. And we have a negative gap currently.
Can the monetary growth and inflation, what can you tell us about historically? Are there any periods in the past where we experienced what we're experiencing now from which we can learn?
I think the only relevant one is really the Depression. The problem is that the Fed, let me find that, has put a lot of money into the system, but because of tightened banking regulations since the crisis and because of uncertainty by business owners, you kind of have this tug of war between banks not wanting to lend and businesses not wanting to borrow. So what happens is the Fed can put all the money into the system it wants. If it doesn't actually get used, it doesn't cause inflation. And I think the most relevant time would be the Depression. I mean, I can't think of any other time. So looking at commodity prices, 3 different indexes here. The top one is heavily weighted to energy. About 70% of that index is either oil or heating oil or gasoline, basically petroleum products. The second one only has about a third of it in energy, and then the last one is equally weighted among like 24 different types of commodities. All of these are multi-commodity indices, but you can see that basically they've gone nowhere since 2011. So you're getting no push on inflation from the commodity sectors. This is that capacity utilization chart on the bottom here. You can see you don't usually have an inflation problem until you get up above, say, 85% capacity utilization. Currently, we're only at 78, so there's excess capacity there. This concept of the turnover of money in the system or the velocity of money, M2 is a very common measure of the amount of money in the economy. It includes your checking account, your savings account, money market accounts, CDs, and a couple other oddballs. But as you can see that back in 1995, for example, we were seeing turnover of above 2 times. Currently, we're at about 1.6. So there's been this decline in monetary velocity really over a number of years, but certainly since the recession. MZM is another measure of money. It really just includes savings and checking. So you can see the low turnover there. You combine all of that, capacity utilization and unemployment and so forth, you get this concept of what potential GDP growth is, and you can see that our actual growth is well below that. So there's very little pressure on inflation from a variety of sources. So looking kind of at quantitative numbers to kind of get an idea of whether things are kind of staying the same or showing any sort of improvement at all, I like to use this chart from the Organization for Economic Cooperation and Development. They have a series of leading indicators on economies worldwide, and we can get an idea of kind of if things are improving or getting better and so forth. So I really like to focus on the 12-month change and the 3-month change over here because you kind of get an idea of how much it's changed over 12 months and whether the momentum is actually accelerating or decelerating. You can see that the OECD nations in total, and there's like 35 nations that are included in this, that see very small change over the last 12 months. The leading indicators have advanced by about 0.4%. But it has accelerated a little bit in the last 3 months at a 1.5% rate. The US, a little bit stronger, up 0.8%, but much stronger in the last 3 months. Japan's policies, at least for now, are showing some signs of success where their 3-month rate is quite a bit higher. Europe has been flatlined over the last 12 months, but showing some improvement over the last 3. Surprisingly, Greece is showing some strength over the last 3 months. China showing some strength down here, but you're seeing India and Mexico kind of decline. So you get a real mixed message by looking at some of these leading indicators. But, again, the story is sluggish growth and sluggish anticipated growth. If you look at economists' forecasts, go away from the numbers and look at what various economists across the economy are saying, they're looking for 2% GDP growth in the U.S. For 2013, 2.6% in 2014, and looking for inflation to only go up by 1.8% during the year. You look at Japan, much more subdued at 1% this year and only a 0.1% expected inflation rate. The euro area expected to remain dormant really for 2 years, and the only growth you're really seeing is in emerging markets, or the only anticipated growth would be a better way of phrasing that. So let's take a quick look at the bond market. Again, I'm just going to summarize a couple of these things, and what I want you to keep in mind is if you look at this yield column for March here, you can see where the yields, as we all know, are very low. A 10-year yield at the end of March in the Treasury yield here in the U.S. was only 1.87%. Yesterday, it was all the way down to 1.7%. The only place you can get anything that looks like a reasonable rate of return is in the high-yield market at about 5.7%. You can go to emerging markets and get something north of 4%. Everything else is pretty low. So part of our job as being an advisor is to try to make sure that expectations of clients are reasonable and you're not. It would be unreasonable to expect bond returns to be much more than 2, 3, 4%. In municipals, state governments have gotten themselves in much better shape than they were during the recession. State and local government debt service is about 5.2% of their expenditures, which is actually quite a bit better than it was back in the 90s when it was nearly 8%. Muni yields are still generally higher than Treasury yields, which is attractive. As a general rule, we like state municipal bonds. We're not real fond of taking on the risk of localities. So, high yield bonds, again, just a little bit more detail on that. High yield bonds are a real conundrum because It's one of the few areas where you can get any real yield, but yields have come down so dramatically that they're not really that attractive compared to their historical rates. So you can see, for example, we were seeing high yields up in nearly 20%, and these are actually spreads. So what that means is you look at the yield on the high yield index and compare that to a treasury yield, for example. The average spread is about 5.9%. Back during the recession, it was about 17 or 18%. Currently, it's only about 5. So it's actually lower than its long-term average, but you're still getting a much higher yield than you are on treasuries. High yield bond is anything rated below triple B, actually triple B minus. But there's a lot of high yield bonds that you would be familiar with, like Duracell, for example, is a high yield credit. There's a lot of things rated double B or double B plus. And we only use mutual funds when we go here. We don't buy these individually. The other interesting thing is the default rates. High yield default rates have averaged 4.2% a year going back to the late 80s. Currently, they're only running at 1.2%. So you certainly you kind of have to do the trade-off of what the yield is versus what the default rate is. One of the things you should keep in mind and one of the things that we look at is high yield is really kind of a canary in the coal mine for the economy. You start to see these spreads go up in advance of recessions. You start to see the default rates go up. If we're not seeing either of those happening, we're not really anticipating a recession. Emerging market debt is kind of the same story. If you look in this upper right-hand panel, you can see that the spreads there are either at or below their long-term averages, but they have a little quirk as well. The quirk is that, back in the 90s, high-yield bonds in general were basically junk bonds, high-yield bonds. Emerging market bonds were basically high-yield bonds. They've basically come up so that on average, emerging markets are now investment grade, or just barely into investment grade. So a couple of things here to kind of reiterate. Developed markets have slower economies and kind of deteriorating finances. Emerging markets have faster growing economies and improving finances. Look at the stock market. We all know the stock market hit a new high, happened very handily at the very last day of March at 1569. It did go up a little bit in April, and now it's kind of settled back around 1550, I think, give or take. We do not see a fundamental reason why the bull market has to end here, but we do see a psychological reason, which is fairly obvious on this chart, that people tend to get nervous when you hit new highs or you start bumping up against that level. We've seen the market sell off this week. A correction is fully expected, but I'm not so sure. I'm not prepared to say that bull market is over, but certainly a correction is due. One of the things that would cause a correction and investors to kind of reevaluate their exposure to stocks is the earnings situation. Earnings really peaked back in around 2010, early 2011, and have started to kind of slow down again. So earnings per share on the S&P 500, after hitting a low point in the recession, have rebounded dramatically, but they're starting to kind of roll over and slow down. The other thing is profit margins on companies in the U.S. are at all-time highs or near all-time highs, and we can't expect that to continue. So you're going to probably see profit margins start to deteriorate. You're going to see earnings growth slow down, and that's going to cause some problems for the stock market, at least in the near term. Valuations, though, are not out of line. Typically in a bull market, the statistic I saw was that in a bull market, since 1962, the average price-to-earnings ratio at the peak has been 19.9. Currently, we're at 15.8, so it's not anywhere near anything that's out of whack. But we like to look at this chart, which is comparing 4 different valuation measures: PEs, price to book, price to cash flow, and dividend yields, and then combining them into a composite valuation measure. And again, to kind of look at this, the horizontal line is the world average. The gray bar is the 10-year average for that particular country. The brown horizontal line, the gray bar is the range, the brown horizontal line is the average, and then the diamond is where it is today. So for example, if you take a look at the U.S. is always sold at a premium to the world, and the diamond indicates that we're roughly in a fair value range. These are the developed countries here. You can see that Japan appears relatively attractively valued. Some of the European nations are. France in particular is a better deal. International in general is a better deal than the U.S., but the U.S. I don't think is overvalued per se. If you look at emerging markets, you see a lot more variation. Anything from Indonesia and Mexico probably being way out of whack to Russia and China being undervalued. So there is opportunity in the emerging markets, and I think more so than in the developed markets. And then talking about a stock market correction in the U.S. specifically, I always like to show this to just drive home the point that there's always a stock market correction basically every year. You see that in any given year you can see declines of 5 to 20% sometimes, but still most years are positive, as we know. Even last year we had a 10% decline and we still had a 13% price gain and a 16% total return for the year. So you shouldn't be afraid of corrections, and in fact we would expect one. So now I want to get into kind of this bigger picture that I wanted to talk about, which is what is the economic horizon, and we're really talking about a 10-year time frame here. And I probably put these bullet points in the wrong order, because what we're really talking about is what's become known as the new normal. And this was a concept put forth originally by PIMCO, which is a big bond manager up in Orange County, of this concept that because of various factors, the three primary ones being deficits being run in the U.S. as well as most developed nations, debt levels in the U.S. and many developed nations, as well as demographics, are really providing headwinds that will cause economic growth to be subdued for the foreseeable future. So these estimates were put together by a company called Research Affiliates, which is actually kind of an affiliate of PIMCO, but just to give you some idea of what this might mean. So again, we've been running deficits for decades really in the U.S., with bigger ones recently. To cut a 10% deficit to zero in 5 to 10 years is going to reduce GDP growth by 1 to 2% per year in order to get that done. The gross national debt has risen from 50% of GDP to 100% of GDP in the last 30 years. If we were to cut that back to 50%, it would reduce GDP growth by about 0.8% per year. Now, I hate to tell people in this audience, but older people tend not to be as productive as younger people, beyond a certain level. I'm sure none of you have hit that level yet, but so aging tends to slow GDP growth. GDP growth in kind of a broad, general sense is made up of growth in the workforce plus productivity growth. The big model of GDP going back, post-World War II and before, is that basically the labor force grows about 1% a year, and productivity is about 2% a year. That's how you get that long-term 3% average. So slower workforce growth, and we've seen the labor force decline really for some years now, will cost GDP growth of about 0.8% per year. So you start adding those up and you see why you're looking at subdued economic growth. Just to put things in perspective, historically, over the last 50 years, we've had real GDP growth of about 3% per year. The last 25 years, it's been 2.5. The last 10 years, it's been 1.7. And the last time we've had a 12-month growth in GDP, not a quarterly annualized rate like it's always said in the paper, but actually a 12-month growth greater than 3% was back in the second quarter of 2006. So even in this rebound from the recession, where we've had some quarters grow at an annualized 4%, we haven't actually seen 12-month growth exceed 3 since 2006. So here's a chart of the budget deficit to kind of put some pictures to those statistics. So we did hit a 10%, actually 10.6% budget deficit back in '09, and this is on a rolling 3-month basis, basically. We've cut it back to 5.8, but as you can see, we've generally ran deficits with a couple of exceptions going back to probably even back further than this chart goes. So again, cutting that back to zero, I don't think we actually have the heart to do that, but that would in fact cut GDP dramatically. Part of the problem is, and I've talked about this in past talks, is the fact that the federal budget, as opposed to state budgets, I think every state except perhaps one does have a balanced budget amendment. That is, they have to balance their budget on either a 1 or 2 year basis. Now, they may not. There may be some crisis why they can't do it, but at least they have to start the period saying, gee, we've matched our revenues with our expenses. Right. The federal government doesn't even do it on paper to start. They start every year, they know they're going to run a deficit. There's not even an attempt to balance it. And as you can see over time, and this chart going back to the 60s, but for those of you who were here a year or so ago, I did one going all the way back to the 30s, and it's basically the same, that there's about a 3% spread between what the government takes in and what their revenues and what they spend each and every year. And it's fairly consistent. I mean, there is some yearly ups and downs, but when you average it over time, it's a fairly consistent relationship. So it brings in about 17.9% revenues as a percentage of GDP, spends about 20.6. You can see during the recession that spread got very wide and it started to narrow back down again. So again, to put a picture behind that's the deficit side of it. Now this is the debt side of it. So federal debt is generally conveyed in 2 different ways. Either gross federal debt, which is literally all the debt outstanding, is now about 103.7% of GDP. Publicly held federal debt, or what's sometimes referred to as net federal debt, which subtracts out the debt that's owed to another branch of the government. For example, the Fed has been buying Treasury securities, therefore the Treasury owes it to the Fed, is about 73.1% of GDP. You can see how these numbers have risen dramatically, really since about 1980. The bottom chart shows household debt as a percentage of GDP. So you've got total credit market debt is the blue line, and mortgage debt is the red line. And you can see that consumers have made progress in reducing their debt load. The federal government has not. So what does that mean for the economy? Oh, I'm going to go back to this one real quick. I didn't put this question was asked of me yesterday, so I'm going to head this off at the pass before somebody asks it. This is only talking about Treasury outstanding, essentially. What about state debt levels? What about the obligations we have for Social Security, Medicare, and so forth? I do have a chart from PIMCO on that, but you don't want to see it. Because this is showing you 103.7. It gets up to nearly 600% when you put that in there. Now, let me tell you how they get up to that. As you know, Social Security and Medicare are promises to pay in the future. So it's much like pension accounting. You know what your retirees, you know what your workforce is, and you can estimate what your liabilities are going to be in the future. And then you have to discount those back to a present value today. So what they're essentially looking at is demographically what those liabilities might be, and then they use relatively low discount rates that we have today to discount those back. So that it's an estimate. It's not literally debt outstanding like this is, but it is sobering to think about what those responsibilities are going forward.
Ken, can I interrupt?
Sure.
Can we have the AC turned down in here? It's, I think,
Too hot or too cold?
too cold.
Too cold.
Do you agree?
Now it's too cold. Okay. Yesterday it was too hot. So,
Too cold today.
okay.
Well, tomorrow it'll be just right.
I just want to keep you guys awake. I realize. Okay. So that's the bad news on that. But there's always, there's multiple things to look at here. If the government really made an effort to pay off its debt and reduce its deficits, obviously it wouldn't be spending as much in the economy, and economic growth would be slower. So there's a lot of ways to look at the economy. I think we've all heard that personal consumption expenditures make up about 70% of the economy, and you've got exports and you've got imports and you've got residential investment and so forth. This is breaking it up into just three broad categories. You've got personal consumption expenditures, you've got government purchases, and then you've got basically everything else. So the thing I want to talk about specifically is if you look at government purchases over on the right-hand side, if you count those little quarterly bars, you'll see that the government has been a net detractor from economic growth for 10 of the last 12 quarters. That is, historically, they've tended to be a positive contributor to economic growth, but since really in the last 3 years, there's only been 2 quarters where they've been a positive contributor. So even though the debt levels have been rising, we did see back here that the deficit has been contracting, and part of that is manifested in the fact that you've had negative contribution from the government to GDP growth. There's a couple of odd outliers here. One happens to be the third quarter of 2012 when there was a big amount of spending right before the election. Don't know why. But, and then a big decline in the fourth quarter to offset that. So what does that look like if you look, again, broadly internationally in terms of debt to GDP ratios and what that might mean for balance sheets of various countries? So this is looking at a chart that's looking at real GDP growth on the left-hand side for the last 2 years and then estimated for this year. So obviously you want to have faster GDP growth. Gross debt to GDP ratios, and you'd rather be on the left-hand side here. You can see Japan is way out of whack on the right-hand side where they actually had to break off the chart because it's so far out there. You can see that primarily the developed nations are kind of in this range where you don't want to be, and the emerging market nations are in this range where you do want to be. So again, better GDP growth, better balance sheets. Looking more specifically at that demographic portion of those 3 Ds is kind of interesting. So this is a chart from the Census Bureau that's looking at median age by country in 2012 and then forecasted for 2050. And I've highlighted the U.S. here. So currently we're at about 37 and a half, give or take, on a median age in the U.S. And again, median is that point where 50% are higher and 50% are lower. It's the exact midpoint. Forecasted to go to about 40 by 2050. Now, look at, again, in kind of a generalization, European countries and Japan are older. Emerging market nations are younger. So again, younger populations tend to be more productive. There are some quirks here. For example, you can see China, with their one-child policy that they've had for a while, is currently about the same age as the U.S., but they're expected to get much older by 2050. And then look at Japan, which has, and there's more to do here than just birth rates. There's immigration policies and so forth. Japan, for example, has very tight immigration policies. We're very liberal compared to them. And so, it's anticipated that we're going to have immigrants that are younger and kind of keep this median age more under control. Japan is already very old and doomed to get much older. So again, my apologies, because I didn't make this chart. It comes from the Census Bureau. So don't shoot the messenger, but this is called old age dependency ratios. So what we're really looking at here is the ratio of people age 65 and higher compared to those younger than that. And the point here is, of course, that many of the social programs, whether it be corporate pensions or Social Security or Medicare, depend on having a younger population paying into the system and supporting the older population. So again, I've highlighted the U.S. here. We have a current dependency ratio of about 0.2. By 2032, it's expected to get up to about 0.32. Now, 0.32 is similar to what you see in Germany, Sweden, Italy, and so forth, below what you see in Japan today. And of course, Japan, is expected to get much higher. Hong Kong, expected to get much higher, so forth. So again, but the general pattern, developed countries have higher current old age dependency ratios and expected to get higher. Emerging countries have lower, and although expected to get higher, not most of them not approaching what we see in the developed nations. So, kind of the whipping boy for this demographic problem would be Japan, and we've already seen they have a high median age, they have a high old age dependency ratio. What has that really meant for their GDP growth? Well, they've only grown at 0.9% per year over the last 20 years. I mean, that's pretty stagnant. And their inflation rate has generally been, zero, or in many times negative, as you can see, going back to 2002. So I'm not saying that's the U.S.'s future, because I think we do have a better demographic situation, and I think we have a more vibrant economy. But that's kind of a worst-case scenario, as you see that general lackadaisical GDP growth and very low inflation. You guys warm enough now? Because I am. Okay, now it's a sauna. Okay. Is there any bright spot to this? And again, I'm not painting a picture, I don't think, of depression forever. I mean, it's just really kind of sluggish GDP growth. But there is at least one bright spot, and that is we're starting to see signs of a manufacturing renaissance in the U.S. And this is driven by several factors. One of which is one of the reasons that U.S. companies were offshoring in the first place is they could get much lower labor costs in many of the other countries. That's still the case, but it's decreasing. And you combine that with increasing logistical costs of getting things shipped back and forth, the advantage of offshoring has been deteriorating, and we're starting to see a lot of companies move things back into the U.S. A big factor in that is the relatively low cost of energy in the U.S. Natural gas prices are half here what they are in many countries in Europe, for example. So manufacturing costs can be kept under control other than labor costs because of low energy costs. The other thing is there is a corporate piracy problem in many of the Asian countries that frankly, Apple and a lot of the tech companies would prefer to avoid. According to the Boston Consulting Group, the U.S. could see an increase of 2 to 3 million jobs over the next decade as a result of reshoring of Chinese imports and increased exports. And I've got a couple of charts just to kind of talk about that subject. So many times when I do these talks or when I talk to clients, oftentimes what they say is, well, gee, the U.S. doesn't make anything anymore. And that's maybe what they see in the paper, but that isn't true. The U.S. manufactures nearly 75% of what it consumes. Furthermore, according to Business Week, the U.S. manufactures 21% of all manufactured goods in the world, which is 6% less than China and Japan put together. So, we don't manufacture shirts and shoes much anymore, but we do manufacture aerospace products and other types of things. So this breaks it out into basically these green bars are the amount that we manufacture and consume, and the yellow ones are the rest of the world. And you can see the high labor cost areas like footwear and apparel and so forth, a lot of computers and electronics, are manufactured outside the U.S. because we can't match their labor costs. But anything that is more of a value add or that we have the natural resources to do, we tend to produce here. So as a further take on that, a Boston Consulting Group broke down the types of industries that tend to be offshored versus those that tend to be onshored, and how some of those things may be changing. So basically, if you look on the left-hand side, you're looking at labor costs as a share of the total product cost. So if you're going out and you're buying a pair of like a shirt at Walmart that's costing you, $10, the labor costs, you couldn't make that in the U.S. and sell it for that. But you can make it overseas because the labor cost is much lower. But it's still a relatively high part of the total cost. There's not a lot of material costs going into that. So high labor costs as a percentage of the product cost combined with low logistical costs tends to be things that get offshored. If you have low labor costs as a percentage of the product cost, so you've got a lot of value add in there somewhere, and high logistical costs, it tends to be produced here. So you can see these are industries that tend to be produced here. Again, textiles and footwear and apparel tend to produce offshore. And in the middle, you have some of these that are kind of dynamic and moving back and forth. And they're highlighting 7 areas here: furniture, fabricated metals, machinery, and so forth, that are tending to be moving back to the U.S. So that's, one bright spot. So what are the investment implications of all that we've just talked about? So if you look at bond returns historically, the best estimate of what you're going to get on a bond is really what your current yield to maturity is. So if we're saying that the 10-year Treasury has a 1.7% yield today, obviously if you buy it today and you hold it for 10 years, you're going to get 1.7%. It's not a very high return. But if you hold it for just 5 years and sell it, that 1.7 is still your best estimate of what you're going to get. It will be different, but it's your best guess. And there's about a 0.9% correlation between what the current yield and what your future total return is. We would see subdued U.S. stock returns. Returns on any asset are basically a function of what the yield is on the asset, what the valuation is that you pay for it today when you buy it, and what any growth is in the earnings on that asset. And I have a chart to kind of talk about that in more detail. So we would advocate that you increase the exposure to emerging economies, both in stocks and bonds. And again, not necessarily for this year or next year, but inflation protection for that, insurance in case everything kind of goes wrong and the Fed can't do what it says it can do and take all the stimulus out. So this chart is just kind of a background on a couple of different environments. And the reason I put this in here is, again, to kind of hammer home the point that I think we've gotten used to relatively high returns from bonds and stocks, if we go back long enough, go back beyond the last 10 years for stocks anyway. But there was an environment where we didn't see quite so high of returns, and maybe that's more like the environment we would expect to see going forward. So from 1958 until 1981, we generally saw rising rates and interest rates. You can see that 10-year bond yields started at about 3.5% back in 1958 and rose to a high of 15.8% in September of 1981. The gray line is the real Treasury yield, which is the Treasury yield minus the inflation rate. And you can see that over time, most of the time, you have a positive real yield, though we did see negative real yields for a while in the late 70s and early 80s, and we currently have been seeing negative real yields as rates have been driven down to very low levels. If you look in these little boxes here, you can see that from 58 to 81, corporate bonds, a broad corporate bond index, returned 3%, but inflation was 5%, so you had a negative real return of 2% per year on average over that time period. Stocks, on the other hand, returned 8.6%, which is far lower than the very long-term average of about 10% that everybody thinks about, but they still managed to do better than inflation and produced a 3.5% real return. Since 1981, despite all the ups and downs of the 87 crash and the flash crash and whatever other environment you want to talk about, stocks have been a very strong performer at 11% per year, with inflation at 3.1, so you've had a 7.7 real return. So you've had a very good environment. But the reality is you've had a very good environment for bonds. You would have made 10.1% in the bond market, which was a 6.8% real rate of return. But you can't look at a chart like this and say, gee, I'm going to get 10% on bonds going forward because yields are so low, it's virtually impossible. In fact, it is impossible. So that's the point there, is really that we've been in this great environment, and hypothetically, we're in an environment now, I think, going forward that might more resemble something like that. So you can look at bond returns and basically decompose them into three different parts. You look at what your current yield is, yield to maturity. You look at an expected default rate, and you look at whatever inflation premium happens to be priced into the bond that you're looking at. So when I put this chart together, the yield on the Barclays Aggregate Bond Index, which is the broadest index of bonds in the U.S., it's only investment grade, it doesn't include high yield, was 1.8%. It's about 35% government bonds, and then it's got another 35% or so in mortgage-backed bonds. There's historically been a very small default rate on even investment-grade bonds in the index. And at the time I put this together, when inflation, as we knew it, was about 2%, and the yield was at 1.8, there was no expected inflation priced in. That is, there was no inflation premium priced into the index. So that gives you an expected rate of return of maybe 1.7%. Over the last 30 years, you've gotten 8. That environment doesn't exist. So today, if you kind of weighted your portfolio more towards corporates and less towards treasuries, if you put in some high yield and so forth, I mean, we think that you're looking at, over the next 10 years, bond returns that are going to be somewhere between 1.5% to 4%, depending on how much risk you're willing to take. In the stock market, historically, when you buy at various PE ratios, we can map out what you would have gotten in terms of return. And this data goes all the way back to 1913. So again, the current PE ratio on a trailing 12-month earning basis is 15.8 times, and the current dividend yield is 2.2. These returns are only price returns. They don't include dividends. So historically, buying at this level, we would have seen a 6.5% per year price gain. And then, again, today you'd have to add in the 2.2. So maybe you're looking at 8.7% on equity returns going over the next 10 years. Again, you compare that to bond rates, and it looks fairly attractive, but it's not the 10% or 12% that we became used to. Again, you can decompose equity returns into various factors and come up with another estimate. So you start out with your dividend yield of 2.2. Academics like to break out earnings growth into real numbers. So, you look at the earnings growth above inflation, which since 1900 has averaged 1.7% per year. And over the last 50 years, it's been 2.1, and over the last 25 years, it's been 3.8. So, I don't know what the most reasonable number is, but I don't think it's going to be at the high end, given the factors we just talked about. So I'm just throwing in 2 as a number here. Expected inflation, we've already said the Fed really targets inflation of 2. If it gets to 2.5, they're going to take their foot off the gas. In the bond market, the expected inflation rate, when you look at inflation index bonds versus regular bonds, is pricing in at 2.6%. It's as good a guess as any, I suppose. I would say the economist estimate, consensus estimate over the next 10 years is actually 2.3. You add those all together, and then you have this concept of, well, there's a valuation that's placed on those earnings. So I've already said that the inflation at the PE ratio is 15.8 currently. If you look at the long-term median, it's 15.5. We're basically right on that. If you look at the long-term average, which for the statistical-minded, that averages can be skewed by extreme readings. So we've generally had higher PE ratios over the last 25 years than we did prior to that. So the long-term average is about 17. Stock returns are often looked at going back to 1926 because that's when good data really started. But in fact, the S&P 500 only started in 1957. So the median going back to 1957 is 16.5. So one could make the case that you have room for valuations to go up. But again, given the headwinds that we have, I don't know that you want to bank on that. So you add those together, you get 6.8%. So I think a reasonable expectation is that you say over the next 10 years, we're going to get something between, say, 6.8 and that 8.7, and say that that's kind of my expectations of what stock returns are going to be. How can you hedge against inflation, and how can you maybe make your portfolio do even better than that, is by adding some other asset classes to it. So as you all know, on your reports, there's a section that's called alternative strategies, and in that area are basically some mutual funds that either invest in commodities or invest in market neutral kind of strategies, or there's some individual REITs, or there's some mutual funds in there. These are ways that you can diversify and keep up with inflation. And this is just an example here of an investor with 70% in stocks and 30% in bonds since 1994 through 2012, and then hypothetically what that would look like. You all seen charts like that showing various changes to the mix. But by adding in market neutral commodities and REITs, what we would generally call an alternative bucket, you can actually increase the return, or you would have increased the return, and you'd actually lowered the volatility of the portfolio by doing that. And REITs and commodities in particular are very good inflation hedges. The other thing to look at is, I like to put this chart up here periodically, and it's recently been updated through 2012. Dalbar Associates is a firm that's made a living by analyzing mutual fund flows. That is, they look at daily flows into all the mutual funds that are available in the U.S. and try to get an estimate of what the average investor has earned. And what I mean by that is, when you look at any mutual fund, it's going to say that it earned 10% for the last year and 8% per year for the last 5 years or whatever. But there's always flows into the fund, both in and out every day. So by looking at those flows, they can make an estimate of what the average investor actually earned, because the average investor didn't own it from day one through the most recent period. And as you can see, that the average investor has earned 2.3% since 1993 compared to these various measures. Inflation's been 2.5%, stocks have been 8.2%. Basically, by having poor behavior, the average investor has not kept up with any of these indices. So the final thing on asset classes is, and I've shown everybody this chart before too, but just to remind you that in a low inflation environment where we anticipate the possibility of inflation rising, your two best asset classes to own have historically been equities and commodities. So again, that's why we would advocate those alternatives in there, as well as a reasonable exposure to equities. I mean, I've kind of been talking bad about bonds, but the reality is everybody in here owns bonds, and they need to own bonds for the income part of it. But you have to realize that income part of it is subdued. So the summary would be: long-term strategic view, stocks are preferable to bonds. We would seek to, over time, increase allocation to emerging markets. We like to own alternative assets and strategies, and think they're really preferable to bonds because of their inflation hedging characteristics, because there is potential upward pressure on inflation, again, looking out over the long term. And we would really kind of buy into the whole new normal environment for the economy of 1% to 2% growth. Maybe you're going to see a year or two where it's a little better than that, but I don't think you're going to see any blowout years for a while. Short term, the economy shows some signs of strengthening, but just today the Conference Board's leading indicators came out and they were actually down a little bit. So sequestration and uncertainty as the budget increases the chances of a recession. We still have kind of a temporary agreement on the debt ceiling. There's still more fight about that to come. There's more fight about the budget to come. So that tends to increase uncertainty. And we've seen how people tend to cut back in the face of uncertainty. Inflation remains under control for now. The stock market would seem due for a correction, and bond returns are limited. But again, bonds, as I pointed out, have already gone down since the yields have gone down since the end of March. You know, how much lower can they really go? The 10-year yield at 1.7 yesterday. I've seen estimates saying it can go to 1.25. Currently being supported by, you know, that ongoing threat of recession. We are in a slow economy. There's concern that it could slow even more with the threat of you know, the budget cuts and debt ceiling arguments and so forth. Kind of a quirky one recently is that with this new program in Japan for specifically targeting an increased inflation rate, you're seeing Japanese buyers, where their rates, bond yields are very low, going outside of Japan to buy bonds, and that's been benefiting us. So that, you know, rates have been gone down because we've seen, you know, Japanese buying as well. And then you have the index. So that's all I have, and that's probably enough.
Thank you very much for listening to our presentation. It's important to note that past performance is not a guarantee of future returns. Nothing presented in this presentation is or is intended to constitute investment advice, and no investment decision should be made based upon information provided in this presentation. While WheelerFrost has used reasonable efforts to obtain information from reliable sources, we make no representations or warranties as to the accuracy, reliability, or completeness of third-party information provided. Information provided reflects WheelerFrost's views at this particular time. Such views are subject to change at any point, and WheelerFrost shall not be obligated to provide notice of any change. Thank you once again.